Welcome to WMRE's Common Area Podcast. This podcast is brought to you by the award-winning editorial staff at WMRE. Let's jump right into this week's podcast.
Hello and welcome to the Common Area with your host, David Bodamer. David, what's going on?
I'm doing all right. Just excited to have another conversation with a great guest that I brought in this week.
Yeah, before that, for the longtime listener, we're doing the Philadelphia Countdown Watch. What's going on there?
Or Pittsburgh.
Pittsburgh. Oh, I was totally wrong. Well,
Yes.
Not really.
Same state, but just getting ready for the move in 2 weeks. So I think the next episode we record should be from the new home office.
Oh man, that's exciting. All right, that's great for the audience to hear that. Now on to your guest. Who'd you bring on the show?
So for this episode, I have with us Mike Acton, who is the head of AEW Research and Strategy. Mike, thank you for coming in and joining the podcast.
Oh, great. Thank you, David.
So before we get things going, and if you just wanted to give you an opportunity to, for folks who don't know who AEW is, if you could just give a brief description of the firm and what your role is with them.
Sure. AEW is a global real estate investment manager. We span North America, Europe, Asia Pac, both in direct private real estate, credit, as well as listed securities in real estate. I'm the head of the research team in North America. Been with AEW since 1990, so a long time. Seen a lot of interesting cycles, see a lot of changes in the industry over the years, and that's who we are.
Cool. So that's what I wanted to get your perspective, just from, because of all the different ways that AEW, just the different markets and different strategies and just your role. That's kind of why I wanted to just, have a conversation, because we are at this interesting time in the cycle where there are both challenges and opportunities. But I guess, just to first of all, what does it mean to be the head of research for AEW, and how does that play into informing what the funds are doing?
Yeah, no, it's a great question. It's changed a lot in the time I've been here. Back in the early 90s, a big part of doing research was really going out into the field, so to speak, and getting information. There wasn't large third-party information sources supporting commercial property investment. So a lot of time was spent talking to brokers, touring markets, literally getting real data from any source you could. You fast forward to today, and there's enormous information resources. Real estate has become an incredibly data-intensive, informationally efficient capital sector, very much like other parts of the capital markets. And a lot of our job today is really interpreting, putting together the mosaic of information from disparate sources, trying to funnel through all this stuff and separate out what's really actionable from what's just sort of noise. And I think everybody, not just real estate, I think every sector today really struggles with almost too much information rather than the too little information that existed when I started. So that's a big part of the role of our group. We are decision support for the firm. I have internal clients, I have external clients. And internally, my team works directly with acquisition officers, asset managers, portfolio managers, trying to make decisions every day about investing capital, managing properties, capital structure on those properties, when's it time to sell, portfolio construction, things like that. My external clients, of course, are all of our investors, and I spend an awful lot of my time going and speaking with them to hopefully to explain to them how we see what's happening in the world, why we're doing what we're doing, and really creating a partnership, and very much in many cases really working as extension of their staffs. Most of our investors don't have the luxury of having a really large real estate investment team. Mm-hmm. And so we offer ourselves as a resource. When I say ourselves, I offer my research team to them as a resource to give them leverage in what they're trying to do internally as well.
And those investors, are you working with institutions, high net worth, family office, and even into the wealth channel? Are you looking at do you have all kinds of investors that are working with AEW?
Yeah, I mean, we are looking at all of those primarily, historically anyway. Most of our investors were institutional pension funds, foundations,
Hmm.
endowments, sovereign wealths, family offices, high net worth, that sort of thing. And, increasingly, the entire investment industry is moving more and more towards having products and offerings that would be applicable to a broader set of investors. We don't really have many things that are accessible today to smaller investors, though I think that's where a lot of the industry certainly is headed.
And you're looking across property when you're assessing opportunities, you're looking across property types, across markets, and also I think just looking at the strategies listed on the site that there's core, there's opportunistic, you're looking at the debt side as well. So you're basically kind of looking at assessing everything.
Yes, AEW is very much an investor across the entire risk return spectrum in both debt and equity. On the debt side, it's really private debt. On the
Mhm.
equity side, it's both private equity in commercial real estate as well as the listed, the so-called the REIT sector, so to speak.
And so
Uh,
given that, sorry, go ahead.
Oh, I was just going to say all the way from core strategies all the way up through value-added opportunistic strategies. Really, really trying to offer the solutions that our investors need, and they have very different needs.
And so just given that vantage point, what are some of the top themes that you're like, looking at or talking about right now?
Well, I think the biggest theme in commercial property today is the very rapid change that's happened in the credit space, in the
Mhm.
availability of credit for property. There's been a very significant pullback by lenders over the past year. No surprise, it's largely in response to the rapid change in the yield environment that's happened as the Fed's engaged on the fight with inflation and the rapid change in interest rates. Uh, Really, very quickly, the transaction market in commercial property in the U.S. has become quite constrained. The
Mhm.
constraint really is coming from the financing side, the ability to finance, whether or not that financing is accretive to assets at current yields and things like that. So far, it's at least where we stand right now. It's not as much related to the operating fundamentals of
Right.
properties. An exception to that, of course, would be the office sector, and we could certainly talk about that. Very, very different than what was playing out in the GFC period, the financial crisis period, where the operating portion of the properties got hit pretty quickly, largely because there was a very significant recession underway. That hasn't happened here in the U.S. Yet. I guess we'll say yet. Could still possibly be part of the mix as we get through the end of this year and into next year.
Yeah, I think that's an important point. I mean, I keep seeing a lot of sort of doom gloom and doom type headlines about commercial real estate in general, and also trying to just draw comparisons to the great financial crisis. But I've been around to a few real estate cycles myself here on this side of things, and it just feels very different to me, exactly for reasons that you just talked about. That the fundamentals, again, aside from some of the office, which we know has got a restructuring that it needs to go through, but and a lot of other property types, fundamentals are pretty decent. And so what we're looking at is just a valuation change that's driven by just the cost of capital, as opposed to something that's like a fundamental real estate recession. I guess that could change if we actually do have a real recession at some point that affects demand, but that's just like doesn't seem to be where we're at this moment. I mean, what do you think?
Yeah, no, I think that's absolutely right. I mean, you got to put yourself back into that GSC period. The U.S. lost about 9 million jobs pretty quickly, and that created stress right away in tenants, and then ultimately in property owners and their ability to service their debt and all of that. That hasn't really happened here again yet. It may still, but here it's a very different situation. The problems the banks are having right now isn't caused by problems with the quality of the real estate loans that they've made and things like that. It's really the problems they're having is how quickly interest rates changed and
Mhm.
whether or not they were sufficiently hedged against that change. It's not a credit quality thing. All of those government securities that banks bought as reserve, they're all money good if you can hold them to maturity. The problem is that there was a couple of bank runs and they couldn't hold them to maturity, right? So you have a mismatch between assets and liabilities. That is sort of the definition of what a bank is, by the way.
Right.
Borrow short and lend long, and it's when the issue gets forced through a run. And I think we have to really appreciate how much technology has changed how quickly a bank run can happen.
Right.
It happens in minutes now instead of in days as it used to. So yeah, the operating conditions of the properties themselves is very, very different. Generally speaking, there's not many problems except again in office, and office is we've sort of been referring to it as the elephant not in the room, if you will. because that's the whole problem, right? If offices aren't being used as intensely as they were before, ultimately in a lot of cases they'll be valued less by the users, i.e. rent.
Right. Oh, excuse me. And I think one of the problems that's also been identified is that there's been talk of repurposing offices, but it's easier said than done given the way that the floor plates are set up. If you think about where the plumbing is for an office layout versus where it would need to be for a residential, that creates some challenges like that. I think a lot of people think it should just be this quick flip over, but it's got to be specific opportunities where it could be cost effective to do it.
Yeah, I think that's right. And the part people probably don't think about much, especially if they're not operating in the spaces, they don't think about the change in value that has to happen on that property in order to make the economics of conversion to something else viable. So it can be a pretty meaningful number in some cases, even if the property could physically be changed. Just the capital that's going to be needed to make that change is going to be quite significant.
So do you see opportunities in particular property types right now, or in particular kinds of strategies? Like, is debt a good place to be, or some value at, just like in terms of looking at your matrix, is there a certain place that you're leaning right now?
Well, yeah, we're certainly really excited about the opportunities that are presenting themselves in the debt space. I mean, when you think about it, if some of the largest lenders are naturally constrained and pulled back from lending, that creates an opportunity for others to take that place. Now, you want to do it in a very thoughtful way, but I think there's going to be a lot of opportunities for that. There's going to be a lot of opportunities for what people broadly refer to as rescue capital. Loans maturing today, in many cases, will not be able to be refinanced at the same proceeds needed to retire the existing debt. When that happens, somebody has to make up the gap. Somebody has to put in fresh equity. They have to come up with more creative debt solutions. That might be debt solutions that involve, mezzanine or more junior loan positions, that sort of thing. So there's going to be a lot of opportunities on the capital structure side. Of course, you always want to be focused on places where it's the capital structure that is either broken or strained, not the underlying property. So you're going to have to be very selective. As far as property types themselves go, I mean, the most obvious one right now that is just on the cusp of an emerging, I guess we'll call it a cyclical recovery, is the senior housing space. Senior housing was very, very hard during COVID, right? All kinds of restrictions on people moving in, accelerated, people getting sick, people passing away, that sort of thing from COVID. And that's a property sector that has really great protocols in place for dealing with all of these things. But they still did suffer, reduced occupancy for all those reasons I just mentioned. But people still need the underlying services provided by senior housing. We have a very large baby boom group. They're getting older every day. The front edge of that's just getting close to 80. So the demand is coming back. The occupancy numbers are coming back quite strong. The rents are coming back. They're working through a lot of the issues that presented themselves during COVID, much higher operating costs because labor costs went up a lot during COVID for all kinds of industries, but certainly for senior housing. So I think the pieces are coming together for the next several years for there to be a really significant recovery in the senior housing space. So that's one that's pretty interesting to us.
Yeah, that's seniors housing. We actually do an annual piece of research with the National Investment Center to look at some of the sentiment in that space, and we're about to field that now. So it'll be interesting to see where that sits given to relative. I think this will be like our 10th year doing it with them. So we've got some good baselines in terms of how things have shifted, and things were starting to come back. Some optimism was starting to come back last year, and I imagine it'll be like what you're saying for this year, just because I think some of those challenges are being worked through. But I think it's like you said, with the demographic drivers and just the overall quality of operators in that space too. It seems like it's got a good investment opportunity.
Yeah, I think that's right.
So how do you think, what are some ways to move forward from here?
Yeah, every one of these cycles is a little bit different. There's always some catalyst that gets the property markets trading again. Back in the financial crisis, as I said, the catalyst was really operating problems that properties had because the tenants were under such stress. The economy was under such stress. Today, that catalyst can really be one of two things. I mean, one really obvious catalyst is the loan on the property is maturing. It needs to be refinanced. Over the next 3 years, is about $2 trillion of commercial property loans maturing. Lion's share of those are bank loans. Disproportionately large number of those are office property loans. There's going to be a lot of difficulty refinancing a lot of those. It's going to be very hard to get the same proceeds on the loan. You're going to have a lower loan to value probably on a lower value, probably with an expectation of even lower values over the next year or two. So that's one place where stress in the capital structure is going to cause properties to have to trade hands. The other point of stress that can be a catalyst are really significant leasing events. If again, if we stick with office properties for a second, if you have a really large lease in one of your properties coming due, and either the existing tenant or the new tenant is asking for a lot, they might be asking for free rent, they might be asking for a large tenant improvement allowance, so that they can change the space to be more suitable for the post-COVID norm of what people want in their office space. Those are really big decisions. That's a lot of capital you're going to have to invest, and a lot of property owners are going to have to really take a hard look at their numbers and really figure out how much equity do I have, what am I really protecting, and what's my go forward return on my new equity that I'm putting into this asset. And so that can be a catalyst where you can get properties starting to trade hands as well. You asked earlier about the opportunity in, say, debt investing, for example. Mm-hmm. Looking at these refinancing opportunities as they come up is really interesting. There's going to be a lot of them, and some of them are going to make sense, and a lot of them aren't going to make sense. And again, you have to be very careful about picking and choosing and sort of separating wheat and chaff, as they say.
And it might be difficult to answer this, but is there any thought on when you think that deal volume might pick up again? Because we talked about how deal volume has kind of slowed down, and there are these people trying to figure out how much things are worth, or trying to navigate all these challenges. So that's kind of created this drop in volume. Do you have a sense of when you think things might begin to open up?
Yeah, the deal volume in the U.S. can't really come back to anything approaching normal levels until the lenders are back. Mm-hmm. And there are lenders that are active. There always are, but there's a lot that have pulled back. The banks, in particular, have pulled back. CMBS is less available than it was. Balance sheet lenders, largely speaking, keep lending, right through cycles. Maybe a little more restrained, and by that I mean, usually like life companies. The agencies keep lending on multifamily property. That's part of their mission, so they keep lending as well. But when you take it in aggregate, it's a pretty significant reduction in transaction volume. Now, transaction volume during the COVID period soared to record highs by the middle of 2022 on a trailing 4-quarter basis. It got up slightly over $1 trillion, highest we've ever seen. But understandable, right? The Fed took interest rates to zero. They were aggressively buying bonds to bring down the long end of the curve. Federal government was pumping trillions of dollars into the economy to offset the negative effects of COVID. So it was sort of a perfect combination of events for asset values, for transaction activity, for liquidity. That's all reversing right now, right? The government is pulling money back. The Fed is raising interest rates. They're attempting to shrink their balance sheet. In other words, drain liquidity from the banking system. So all of those things that combine to be a perfect event for transactions are largely now reversed. And I don't see most of that changing. Certainly the rest of this year, probably through the rest of next year. You listen to the negotiations that are going on with the debt ceiling. It seems like spending is going to be a little bit more constrained. You listen to the Fed and the FOMC and the various spokespeople. Seems like they're going to keep credit conditions tighter for longer, maybe longer than the market thinks. So I don't expect any really significant change, probably through most of next year in the overall liquidity and credit availability environment. So again, we're since we have investors that are interested in that, we think it's a pretty exciting time.
And one last question before I let you go, and thank you for giving me your time. Another theme that's come up is that other conversations I've had is this disconnect between public real estate and listed real estate and private real estate, and whether that creates any investment opportunities, just given that there's this gap between the valuations on those two sides.
Yeah, it's an interesting phenomenon. It happens every single cycle. Every cycle, somebody or another points to it as perhaps there's something amiss here. The listed market, the publicly traded market, repriced much more quickly, much more aggressively. Private market is trailing that. I think that's actually a feature of private markets, not a bug or a problem. When I talk to CIOs, they like that aspect of private markets, not just in real estate, but across lots of different areas, because it smooths out returns and earnings over an entire cycle. Listed sectors reprice quickly, usually go too far. The private market follows typically by about a year later, and doesn't have as much volatility. Usually by the time private markets are adjusting downwards, public markets are already moving back up. And they tend, if you look at the data, they tend to meet in the middle and move on again into the next cycle. Right. So, I mean, I think it's the way this stuff is supposed to work. It does create, at certain points in time, it can create a form of arbitrage, if you will. If you can find an asset in the listed market that's trading at a deeply depressed price, and you can move it into the other market at a higher price, that of course that would work. It's more difficult to do in practice than it sounds like in theory, again, because it requires a functioning credit market in some form to make it all work. And that, I think that's a large part of why it doesn't really happen as often as you might think it would. But it's certainly worth looking at, and we and others are obviously looking at that.
Well, before I let you go, just if you want to let people know where they could find some of the research that you put out that's publicly available, or any other information that they might want to get.
Yeah. Like as I said at the beginning, our research is pretty much entirely for the benefit of our investors. We do make some things available on our website, aew.com. So certainly take a look there. And that's there's a few interesting things out there for sure.
All right. Well, thank you so much for your time and for coming on the podcast.
Great. Thanks for having me. And I hope you have a great summer.
Thanks. You too.
Right.
Michael, this has been fantastic. Thank you so much for being a wonderful guest. A lot of great information. David, of course, thank you so much for hosting this. And our last thank you, of course, goes to you, listening audience. Thank you so much for tuning in and listening to the Common Area Podcast with David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. And we humbly ask that you share this podcast, rate it, and leave a review, as this actually helps others find the show. Again, thank you so much for listening today. For everyone at WMRE, this is Eric Johnson inviting you to visit www.wealthmanagement.com/real estate for a wealth of knowledge. And we'll talk to you soon.
Thank you for listening to the Common Area Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of WMRE or Informa. The content has been made available for informational and educational purposes only.